Imagine owning parts of iconic British properties like the Shard, Canary Wharf, or premium retail spaces in Oxford Street without needing millions in capital. Real estate investment trusts, REITs, make this possible, and British investors have unique advantages that most people don't know about. REITs allow you to invest in high-end properties through publicly traded shares, providing access to real estate without the traditional barriers to entry. The British REIT structure, established in 2007, has distinct advantages compared to international equivalents. UK REITs must distribute 90% of rental income to shareholders, creating reliable income streams, and are exempt from corporation tax on property rental income and capital gains, making them tax-efficient investment vehicles. The London Stock Exchange hosts numerous REITs focusing on different British property sectors. British Land and Land Securities focus on prime office and retail properties, while Primary Health Properties specialises in GP surgeries and healthcare facilities. Segro concentrates on industrial and logistics properties, and residential secure income targets affordable housing and retirement communities. British REITs typically offer dividend yields between 3 to 6%, significantly outperforming standard savings accounts in today's low-interest environment. Additionally, these dividends are paid as property income distributions, PIDs, which have tax implications different from ordinary dividends. British investors benefit from holding REITs in ISAs and SIPPs, which allows for tax-free growth up to £20,000 per year in ISAs, providing a unique advantage in the UK's progressive tax system. The British REIT market has evolved differently from international markets. After the Brexit referendum and during the pandemic, many UK REITs traded at significant discounts to their net asset value, NAV, creating buying opportunities for savvy investors. Risk management within British REITs is also unique. Many UK REITs utilise longer lease terms, typically 5 to 15 years, with upward-only rent reviews that offer inflation protection. This is especially relevant in the current economic climate, where inflation is a concern. When evaluating REITs, understanding the British commercial property landscape is crucial. Key considerations include the shift in demand for office space due to hybrid working, the transformation of British high streets and retail parks, the growth of logistics properties due to the rise in e-commerce, and the growing importance of healthcare properties in light of NHS pressures. Unlike direct property investment, UK REITs offer immediate liquidity since they are traded on the London Stock Exchange during market hours. This addresses one of the traditional drawbacks of property investment in Britain, where buying and selling physical assets can take months. For those concerned with ethical investing, several British REITs focus on sustainability and social housing, aligning with environmental, social and governance (ESG) principles that are increasingly important to UK investors. A well-balanced British investment portfolio might combine REITs from different sectors, such as the stability of healthcare properties, the growth potential of logistics, and the inflation protection of residential properties. Investors also have the option to diversify across several property sectors, which reduces risk by providing exposure to various asset classes that behave differently depending on market conditions. For instance, while the logistics sector has performed strongly during the rise of e-commerce, the healthcare and residential sectors may offer more stability in uncertain economic conditions. Diversification helps investors cushion the impact of downturns in one sector while capitalising on the growth of others. Additionally, British REITs have become an attractive option for international investors seeking exposure to the UK property market, particularly as the country's market offers relatively stable income streams and strong long-term growth potential. This broader global interest only strengthens the overall stability of the sector. When analysing UK REITs, it's essential to look beyond simple dividend yield. Consider factors like loan-to-value ratios, which should ideally be below 40% for stability, as well as occupancy rates across the REIT's portfolio, the weighted average lease term (WALT), and geographic concentration within Britain.